Hey guys, welcome back to the channel. Matthew here. I want to start a segment, a series called What Would You Do? We've done a series before called How Did We Do It? And I think this would be a great way to get some of your perspectives in the comments below. But I had a really interesting conversation with you guys, with one of you from last week that I think is imperative for us to discuss given the volatile and kind of scary condition that the economy is in right now. I mean, this is such a strange time. We're sort of hovering around here at the top and things still seem to be getting better. Everybody's still very excited about real estate. It seems like every single person that I get a chance to speak with from the channel here each week is interested in real estate at some point. And so I think discussing timing on this channel is going to be very important. So we're going to toss some resources your way, and I just kind of want to explain the conversation that I had with this viewer. Now, I always protect anonymity if I have not asked for permission to discuss specifics about somebody. So we're not going to discuss this individual's name or anything specific about her, but I will say that she was doing very well initially. I mean, so she's a brand new coaching member. We let in anywhere between 7 to 10 new coaching members each week, depending on availability. So very limited number. In addition to that, I spend about 6 hours per day having conversations with you guys for free on our free coaching sessions. And I do that 4 days a week. So I get a chance to really interact with you, and I learn a lot during that. And I had some concerns about this situation, and I'm curious if you would share my concerns. So we're going to discuss what her circumstances look like. I'm going to give you my perspective on it. I want to give you guys some encouragement to get into the comment section and really tell me what you think. What would you have done? And then I'm going to tell you what I'm doing right now when it comes to real estate, because it's different than what I was doing in the past, and it's going to continue into the foreseeable future, okay? Until the economy shifts again. And when that happens is speculative, right? I have no idea when that's going to happen, and you don't have any idea either. All we can do is guess. All right, so this gal comes to us and she signs up for the coaching. She takes one of the quick start memberships, pays in full, got the best price that we offer. By the way, the prices are going up again. So make sure that you get in there if you have been on the fence about whether or not mentorship is right for you. It is, okay? Mentorship is right for all of us as long as we remain coachable. So she gets in and she explains that she has already purchased 2 rental properties and closed on a third last week. She has 2 additional properties under contract that are expected to close over the next couple of weeks. I should say were expected to close. And here's why I say that. The first one was a $147,000 purchase price, the second being a $119,000 purchase price. So she's buying in that kind of less expensive area. She's purchasing in Jacksonville, Florida. Now she lives in California, so she's purchasing these through one of these turnkey real estate providers. You got to be really careful with these guys. Now, I want to use round numbers for this example. The first question I have is, how much do they cash flow? Her response was about $100 each. So that means that we're going into these purchases with speculated appreciation as the long-term benefit, right? We're looking for these to really go up in value before they're ever going to really produce for us something that is exciting, that's going to contribute to her long-term wealth. I mean, she's coming in with $7,000 in starting cash flow, between $7,000 and $7,500. I mean, it's a phenomenal starting point. So this $100 per month contribution to her is already a little bit of a head scratcher for me, because I'm sitting there thinking to myself, you live all the way across the country. In order to actually take care of these properties, if something were to happen, if you needed to actually go and pay a visit, if you wanted to double check and inspect what you expect, well, that's a pretty expensive flight and time consuming, and you've pretty much all but consumed an entire year's worth of your cash flow and time and money by the time you pay it one visit. So if you pay one visit per year, you're pretty much breaking even at this point. And that's if nothing else unexpected takes place, which we know that this kind of stuff happens all the time with real estate. So for me, it's always about cash flow, right? I'm always buying for cash flow. And I brought this up to her. And I said, let's just consider a couple hypotheticals. Let's take that $147,000 purchase price. Let's just round it to $150,000 for purposes of this discussion, just to make it easy. And let's say that at some point the market turns down. Now, I don't think that's hypothetical. I think that's inevitable. It's just, again, a matter of timing. When is that actually going to happen? I don't know if that's 3 months from now or 3 years from now. So let's be conservatively optimistic that the economy holds strong for another, say, 5 years. I don't think there's any way that that's going to happen, but let's say that it does. And let's assume that she's benefiting from her $100 per month in cash flow and she doesn't have any unexpected expenses and things work out perfectly exactly as she hopes. $100 per month over the course of 60 months is $6,000. So she's basically putting an extra $6,000 in her pocket between now and 5 years from now on that one property. Now, during the next downturn, is it possible that that property would dip by, say, 20%? Well, I think back to my own personal experiences, and between 2005 and 2006, I lost 60% in perceived value of a property that I owned, a fourplex, in a 6-month period of time. So for me, just based on personal experience, I would have to come to this conversation with an absolutely yes, this is possible. And then we would dig deeper into how realistic is it in that specific geographical area, because there's a lot of differences between the types of property that she's possibly pursuing versus what I owned and where it's located and the condition and the types of tenants, etc. So you just start digging deeper from there, right? So the very first thing that we could look at is a website that is called Little Big Homes. Okay, so Little Big Homes is a really cool resource. I hope you guys benefit from this too. And basically it's just real estate market trends on 380 different cities. Okay, and right here you can see that we've got Jacksonville highlighted. I want to just flip over to Jacksonville and see exactly what happened from the last downturn until now. And you can see that right at around that 2007, 2008 point, just like most cities that actually suffered from that downturn, we see a steep decline in overall housing prices. Okay, this is the housing price index here. So this decline is shooting down all the way until they start to bottom out somewhere around 2000 and what I would say is probably 13 and 14. And then it slowly starts coming back up to present day. And if you look, we still have not reached the prices from pre-recession. Okay? So can we look at this house pricing index and safely agree that a potential 20% decline in value is something that she could face? Is there a reason that the national economy could turn down or even a regional economic downturn could affect her housing prices to the tune of at least 20%? I think it's impossible to disagree with that. And when you look at the changes in weather patterns that are happening nationwide, boy, oh boy, would I be scared to be near that coast. So let's assume that it, over the next 5 years, suffers from just a 20% decline. I think that that's even conservatively optimistic. I think it could go down, and again, 30, 40, 50%. I know people that were investing in Florida during the last downturn that saw such huge declines. They just lost everything. And so I look at this and say, okay, well, what happens if that $150,000 property loses just 20% over the next 5 years? It could happen 2 years from now. It could happen 4 years from now. But let's say it happens somewhere within the next 5 years, and she was only making $100 per month in cash flow, or $6,000 over that 60-month period. Well, 20% is $30,000. So my question to you, and I want to see your comments below, is would it be better for us investors to consider buying that exact same type of property in the exact same type of area, in the exact same type of condition, renting to the exact same types of tenants for $120,000 in 5 years versus $150,000 now and collecting $6,000, leaving basically a net outcome of a $144,000 versus a $120,000 difference? I think it's almost so commonsensical that it seems rhetorical. But I might be missing something there. So I brought that up. That was red flag number one. The second red flag was she had just closed on one of the 3 properties that she went under contract with this outfit last week. And surprise, surprise, she gets to the closing table and the expected cash flow had been chopped in half. The cash flow that she was anticipating based on the analysis that this group did for and with her dropped from $110 per month, which is already too low in my opinion, to $57 per month. Why? Because they had failed to properly estimate the taxes. They had given her the previous year's tax liabilities versus current year, which in my opinion seems like a very preventable mistake, especially for professionals. I look at that and say, boy, that has me really concerned, because who's to say that these next two properties that you're under contract for and ready to close on aren't going to come back at half the net expected cash flow position or worse. Also, then you're stuck with basically a break-even property in an area that's extremely volatile. Okay, it goes up, it comes way, way down, still hasn't fully recovered yet. So you want to be stuck in a property that might lose a substantial percentage of its perceived value and after a decade still not recover? Man, to me, that just seems like you're holding a total liability, especially since it's completely across the country. And I don't think she made any mistakes in this. This is just a common enthusiasm that we're seeing regarding real estate, where people are willing to cut into their cash flow positions in order to get a deal. And because she's in such a great place professionally and with her current cash flow, this wouldn't break her. She could buy these two properties. I told her the same thing. Look, you could close on these next two properties that you're under contract on, and we could have them paid off in about the next 3 years. With a starting cash flow position of between $7,000 and $7,500 per month, she's in good shape. This isn't going to ruin her. And then when they're paid off, they're obviously cash flowing well, and might be a part of her long-term wealth portfolio. But again, with various weather inconsistencies, who knows? Those properties could be wiped off the map. On the other side of the coin, 5 years from now, those things might be rubble because of the next terrible hurricane. So I gave her those things to consider, and lo and behold, she sent me an email shortly after the conversation. She said she pulled out, right? And this was just discussing pros and cons. I was not insisting she went one direction or another. I was insisting that she look at all of the options and consider both best case and worst case scenarios. And that led her to the decision to walk away from the deals. And she even, from my understanding, had her earnest money on the line. So I'm not sure yet whether or not that was forfeited, but she did have somewhere between $2,000 to $6,000 in earnest money. She wasn't even clear exactly on what they were going to be requiring as far as earnest money deposits on these two properties. She had already put in $6,000, but there was a chance that they would only require $2,000 to be forfeited. So we'll have to find out on that. But she did walk away on these deals, and there's a chance that she walked away on as much as $6,000. And I told her the decision should be much harder if $6,000 would be forfeited versus $2,000. And the decision should be much harder if she's forfeiting just $2,000 versus nothing. If she doesn't have to forfeit any earnest money, then I would just pull out of these deals. This doesn't make sense. Let's find something that makes a lot more sense. And that leads me to the second half of today's episode. So before I dive into what I'm doing now, again, please drop a like on this video if you want me to continue to bring you different case studies that I hear about every day and get your perspective and share my perspective. When you guys drop a like on these videos, it actually shows up more often through the YouTube algorithm, so more people get to see it. And that's really, really helpful for us. So I thank you in advance. So let's talk a little bit about what I'm up to with real estate, because those of you who have had a chance to have a conversation with me over the last, even 24 months, you know where I basically stand with real estate. I love real estate. I've been involved in real estate for a long, long time. Like 16 or 17 years I've been investing in real estate. I'm not an over-the-top active real estate investor because I have a lot of other investments through businesses that, quite frankly, substantially outperform my real estate. But real estate is one of those things that I really like for long-term stability when it comes to the residual income aspect. I just think it's a really, really good play to have some real estate in your portfolio. Again, assuming if that real estate is right for you. I mean, frankly, real estate's just not a good fit for everybody, okay? But if you're crazy enough to like real estate, I think it's important to have some. And so I don't want to be sidelined, but this market terrifies me. I don't want to buy at the top. When I look at numbers like that, look, she could be cash flowing $200, $300, $400 a month. Okay. What's $400 per month in cash flow on those properties, bringing in over the course of 60 months. 24 grand, right? 4 times the 6,000 she would have made at $100. $24,000 per in total cash flow compared to a potential 20% downslide in value. Well, again, would the argument make sense that you're better off waiting until you can get a $30,000 discount versus having to worry about adult babysitting and being a landlord for 5 consecutive years to only bring in $24,000? You actually lose out on $6,000, and it takes a lot more work over that 5-year period. So again, I think that is a really interesting conversation. So for me, I've just been kind of sitting it out. I'm excited for a 20, 30, 40, 50% correction to the marketplace where I'm able to go in and snatch up a whole handful, a whole slew. So what do? We stockpile debt weapons, right? We're getting access to as much liquid capital as possible while simultaneously trying to put our cash to work. And we put our cash to work by eliminating balances. In fact, just one rental property alone, over the last 30 to 35 days, we've attacked and eliminated over $100,000 worth of principal that has been paid off. And there's only a $93,000 balance remaining on that house. And that house is valued at somewhere between 4.25 and 5.25, depending on who you're asking. So what are we going to do now? Well, we're actually going to be pursuing another non-owner occupied home equity line of credit on that specific property. These are rare. They're not available in every state. Most banks don't provide them, but we do know of 2 specific banks that do, one of which I made a video about not long ago, talking about a $150,000 debt weapon that actually fell through, and I share that story with you. And we're going to actually try and replace that through the second bank on this property. And we want to access that so that we can pursue an investment that we found over the weekend. So what are we looking for? Well, we're looking for cash flow, okay? So this might mean thinking out of the box a little bit, which in this case is going to lead us down a road that we've never really been down personally, which is the vacation rental or short-term rental market. I think there's a lot of cash flow to be made. In fact, I'm surrounded by people that are doing it and making a ton of money doing it. And I think that there's a lot of room for correction where you're still safe and can still be cash flowing quite well. But I think there's a few points that we should talk about with this. So let me tell you about the deal. First of all, I'm going to share more with you after we're officially under contract and things are moving forward, but I'm going to be a little bit ambiguous about it until that time. So this is a $625,000 sales price. I do know that this property's been on the market for over 400 days. So a long time. This seller is clearly obviously getting to the point where they're ready, okay? We met with the seller already one time. Now this is a private party where we were referred to this individual, and we know that they're ready to go, okay? They want to move to New Mexico. They live in a resort area, mountain town, and this town has been growing in popularity big time, okay? So I'm extremely excited about the actual market, the area. So we find the $625,000 property, and it's on 5 acres. And we also know that this property has been zoned agricultural, commercial, and residential. So we can easily rezone this to fit our needs. At least that's what we are thinking on the surface, where we could potentially on this 5 acres add several additional outbuildings where we could have cabins and we could actually bring in more space for Airbnb. And I would love to either Airbnb or VRBO this property, whereby we anticipate that it will bring in somewhere in the neighborhood of about $250 to $300 per night based on the Airbnb comps in the area. Now, this property has so many unique features that I think would make it really popular for visitors. But if it brings in, say, $300 per night, and that's fully occupied based on an average of 30 nights per month, we're looking at somewhere around $6,000 compared to a $4,000 per month outflow. So the total cost of this property, given the expectation that we have, is that we're going to be basically sitting at somewhere between a $1,500 to $2,000 per month net cash flow. I think that's phenomenal, okay? And it's also in a very safe area when you're talking about things that are beyond our control, like natural disasters. The only thing that we could really expect in this area is the potential really heavy snowstorm, which never really seems to cause any, substantial damage. At least I don't know anybody that has had that happen. So I think this is a really great play. And here's the one area that I would caution you guys to be concerned. We never saw what is possible when it comes to resources like VRBO or Airbnb, because they weren't around during the last downturn. We never saw what is possible with resources like Uber, if you're investing in their stock, for instance, because they weren't around during the last downturn. So we really don't know what to expect can happen when the market shifts and corrects itself, which is a when, not an if. Okay, and so when the market corrects itself, we're obviously going to see far fewer people spending money, discretionary funds, period. And I think it's obvious to say that a big percentage of the users of those resources are spending discretionary funds on them. But even the professional side, where you have businesses that are using those resources for their employees or for work purposes, I think there will be a significant cutback, because we will see businesses that are closing down. We will see businesses that are slashing their budgets. We will see businesses that are laying people off. And if there are far fewer professionals using those resources as well as a listing on that platform, we're obviously going to see some impact from that. But I believe that a $1,500 to $2,000 starting cash flow position gives a lot of room to come in and knock the prices down from $300 per night to $250 per night. And even at a $150 per night starting point over 30 nights a month, we're still at a $4,500 net cash flow position. So amazing potential. And that doesn't even bring into consideration the idea that we might be able to add additional units for $50,000 to $100,000 each. I mean, we could drop tiny houses on this property potentially and bring in $75 to $100 per night on those same short-term rental websites, which in that case, you're bringing in somewhere between, upwards of $3,000 per month, $100 a night over 30 days. $3,000 a month would potentially have that, $75,000 unit paid off, even with interest costs, in under 3 years. So a lot of really exciting potential with a property like this. So I would encourage you guys to buy real estate based on one thing and one thing only, and that is cash flow. When you have cash flow and you don't plan on selling, the values become a lot less meaningful. Does it really matter what your property is worth if you're not planning on selling it, because you're cash flowing so much each month? You want to hold on to that so that you can have an income stream till the day you die. And even better yet, using some of the techniques from our other videos and attacking those principal balances, paying them off in full, and owning the properties completely free and clear, which is exactly what I intend to do on this property. So I'm going to bring you guys along for that journey. We're going to give you a lot more details as we move forward. But my next step is I'm accessing another debt weapon. We're stockpiling debt weapons and even stockpiling cash right now while we pay off all balances in full. So we're completely debt-free going into this next downturn, so that we're ready, just like you should be, to go in there and snatch up as many properties as your little heart desires, so that, frankly, 10 years from now, we're looking back and saying, we became multimillionaires over the last decade. And I saw it happen the last time. I plan on being a part of it this time. I want you guys to be a part of it as well. So make sure you're a subscriber to the channel, become part of the Cash Flower community. If you haven't checked out those other videos that kind of demonstrate some of the math behind this, make sure you do. Usually there are longer form videos, around an hour or so. Also, make sure you're sharing this content with your friends and family. Guys, there will be blood in the streets. This next downturn is expected to be as bad or even worse than the last one. And you want to be able to capitalize on that, but you also don't want to see everyone you love losing everything. So make sure you're sharing this content with those around you. And also make sure you're dropping a like on these videos. Again, it helps us so much in our SEO, just helping other people discover that there are alternatives and things to consider. And I want to continue to bring you as much value as I can. So I'll look forward to seeing you on the next video. Make sure you drop a comment below. What would you do in that hypothetical that we discussed today? And until we see you on the next video, make it a great day today and take care.